and good evening, everyone. So this is Friday evening. The weekend is just about to start. For most of you, it would have started already. Maybe you are coming back from office or you are already home. And those of you who were working from home, uh, in any case, your weekend has started. I am assuming that you won't have loads of work to do over the weekend. So like all of you, there was a time when I used to really look forward to the 2 days ahead on a Friday evening. And that was my corporate executive avatar about which Mahima talked. And although Mahima has been graceful enough to introduce me, there is still one specific reason why I am showing this dashboard to you, which summarizes my professional background, work experience, and academic background. Something which is very relevant to our session today, which is on decoding the investing genius of Warren Buffett and his lesser visible, but equally, in fact, in Warren Buffett's word, uh, he is almost like the investing spouse of Warren Buffett, and they've such mutual admiration for each other that each credits the other to be a bigger genius than himself. And I'm talking about Charlie Munger, who is 99 years old, 6 years older than Warren Buffett, who incidentally turned 93 years old 2 days back. We celebrated his 93rd birthday. So you would find that while we are delving into the investing genius of Buffett and his partner Munger, through that we will explore and try to extract 5 lessons, to be specific, on how we can adopt these learnings for lasting business success. So what are the lessons in strategy we can pick by looking at the investing genius of Warren Buffett and Charlie Munger? That really is the gist of this webinar, and where my background comes into picture in a very relevant manner. My most of my work experience has, as you would notice, has been in strategy, be it in research and consulting or in corporate strategy. And the last 3 years of full-time corporate stint was in a combined role of head of strategy and corporate communication. So that's something which, as a mindset, therefore, I certainly intend to bring to this webinar. Let me start by asking all of you the easier question. There will be a series of questions I will be asking during this webinar. And this is the first one that I have for you. Was the answer to that question the world's best performing investment fund over the last 6 decades? I think the answer is quite obvious given the title and theme of this webinar, but I'm still asking that question. You can respond in the chat window. Okay, Jayashankar, very nice. So, yes, you are right. Berkshire Hathaway. That's the investment fund that Warren Buffett started in 1965. And if I recollect, Munger came on board as his partner in 1978. Although they had known each other for a long time, even before Buffett started the fund. But Munger was running his separate investment fund, and at some point in time, they saw sense in coming together and becoming partners. Now, let me quantify this. Why is it that we are saying that this is the world's best performing investment fund? Okay. So unless we quantify, it can remain debatable. So when we look at the last 6 decades, since 1965, almost 60 years. So we have, to be precise, we have 58 years. And what we are looking at is something which is a very simple metric, which is aggregate return over this period, which is of 4.3 million%. I think the invite to the webinar mentioned 3.7 million%, but I was actually looking at latest data just yesterday evening, and it was a staggering 4.3 million% aggregate return that Berkshire Hathaway has given over the last 58 years. Just to put this into perspective, if you invested $10,000 in 1965 in Berkshire Hathaway shares, it would have amounted to $378 million by 2022 end, and even higher by now. What that means is, in Indian rupee terms, roughly, if you had invested about 10 lakh rupees 65 years back, you would be sitting at about 3,800 crore rupees today. Okay. Even though the period is a long one, we are talking of 6 decades. But just to compare this to Standard and Poor 500, S&P 500 index, it would have returned just about 25,000% aggregate return, as compared to 4.3 million. 1 million is 10 lakh. So 4.3 million% returns by Berkshire Hathaway. Now, while you are still counting the zeros, and this factoid is sinking in, let me take you to another fact about Berkshire Hathaway. The equity portfolio, so Berkshire Hathaway has both equity and debt portfolio. The equity portfolio is worth about 356 or $360 billion as on August end. Now, out of which, if you looked at 55 companies that are there in the equity portfolio of Berkshire Hathaway, 6 companies out of 55 account for 80% of total portfolio value. We'll be looking at those 6 companies. In fact, we'll be looking at top 8 companies in a short while related to one of the key lessons from this talk. But one of these 6 companies, and one out of 55 companies alone, accounts for 46% of the total portfolio value of Berkshire Hathaway. Which company do you think are we talking about? Which company is that? 46% of total portfolio value, roughly 160 billion, 170, $180 billion of market worth of that company's shares in Berkshire's portfolio is what we are talking about. You can again respond in the chat window. It's an easy guess. I think most of you would get it. Yes, so I'm seeing responses like Coca-Cola, okay, and Google. All right, Shubham. And there are 2 responses which are actually correct. Shubham, you have given 2 responses, and there is one from Palani Chami. I hope I'm pronouncing your name correctly. Very good, Peter also. So I'm seeing more responses in favor of Apple, and that's the correct one. Yes, Apple is the company that accounts for close to 50% of the total portfolio value in Berkshire Hathaway. And so let's go on to our first lesson from how and why Warren Buffett picked Apple. Let me ask you another question. When do you think Warren Buffett decided to invest in Apple? How long back would that have been? We all know him as a canny investor, value investing. So it must have been pretty early, right? Early days of Apple. When really do you think that would have happened? When Berkshire invested in Apple for the first time. And since then, they have invested 13 times in Apple. Okay. So nearly all the responses I am seeing, people are talking about this goes, but in 1970s, it did not yet exist. Apple as a company, it came slightly later. Their first big bang product was Macintosh, which they launched in 1984. And that's where they started making waves globally. Any other guess? I've seen quite a few responses. And one of those responses is correct, which comes from Santosh. And for me, it was quite revelatory when I came across that. The year in which Warren Buffett decided to invest in Apple was as recent as in 2016. and which was in fact 5 years after Steve Jobs' demise. He unfortunately died rather young of cancer uh, in 2011. And 5 years after his death is when Warren Buffett decided to invest in Apple for the first time. And by then, Apple had already long back launched all of the devices that we know of today, and which made Apple what it is today as a company. Now, that's really perplexing, isn't it? Why would Warren Buffett invest in a company whose best devices are behind it? And in fact, since 2016, except for the watch, Apple Watch, there is no device, and that Apple has launched an entirely new device like an iPod, iPhone. Okay, they are more or less upgrades and extensions of existing devices. Why would you therefore find Warren Buffett investing in Apple as late as in 2016? And why not earlier? There is a very valuable lesson for us who are managing businesses, or you aim to start your venture at some point in time, or you aim to be a strategic leader. There is a very valuable lesson here in why Buffett decided to step into Apple as an investor as late as 2016 and not earlier. Okay, very good, Pranav. So you also seem to be warming up to the first lesson. So let me go back to the lesson here, and we will then explore it. Create an ecosystem to achieve sustainable competitive advantage. If you go through traditional strategy literature from management gurus and practitioners, you will find them talking about in unison about creating sustainable competitive advantage. This phrase was coined by most famously by Michael Porter in the 1980s, and since then it has become the holy grail of corporate strategy. That how can a company create and retain its competitive advantage, and that's something which we will explore into uh, when we are looking at why Warren Buffett decided to get into Apple in 2016. Now, Pranav has mentioned in the chat box, this was to focus on services revenues. And you are right, Pranav, we need to look at that more closely. But here is a statement from Warren Buffett, and that is quite insightful. It's a recent statement, April 2023. In an interview, he mentioned a scenario where to an Apple iPhone user, if you offer $10,000 with the condition that they can have the $10,000, but you are not, they can't get back not only that iPhone, they have to now switch to some other smartphone, not an iPhone. And what Warren Buffett stated or asserted is that the Apple iPhone user and owner is very likely to decline that offer of $10,000, but won't sacrifice their ownership and usage of an iPhone. What does that tell you about the nature of competitive advantage that Apple enjoys? And is it only because of the device? That's what we need to think about. Because if Warren Buffett invested in 2016 for the first time in Apple through Berkshire, then he must have been thinking far beyond devices, right? There must have been something in his mind going on where he was now convinced in 2016 that yes, Apple has now earned and can defend its sustainable competitive advantage. But he was not convinced about it in the earlier years. Okay, yes, Pranav, very good. You are hitting all the right tabs. Absolutely, brand loyalty and stickiness. So this statement tells us about brand loyalty and stickiness. If you look at the chart here, I've mentioned March 2016. Q1 2016 is when Warren Buffett started investing in Apple. Since then, look at the stock price gain. What does that tell you? Although this is a company, which is the most valuable company in the world in terms of market cap, it reached $3 trillion a few months back. It's currently at about $2.8 trillion. If it were a country, it would be the fifth or the sixth largest economy in terms of GDP in the world, okay, just after India. So what does this share price growth tell you? Apple has not launched any new revolutionary product or device since 2013, and still look at the, except for the watch, but it pales in comparison to iPhone, iPad, and other devices. But the share price has grown by 6x to 7x. It actually hit a peak of about $200, and then it's trading at about 175, 180 currently. Why do we find 6x to 7x growth in Apple's share price in the last 6 years, even though the company has not launched any revolutionary product or device? And Pranav has started given us that thread there about its services revenues. And that's where Warren Buffett was looking. If you're looking in the right place, you will find the answer, right? So let's look in the right place. Here is the right place for all of you. There are a few things here which are remarkable. So Apple has built its services business revenue, which has quadrupled in the period since when Warren Buffett invested in Apple. If you look at around $20 billion in 2015-16, last fiscal year, Apple closed its services revenue business at about $80 billion, and it must be reaching about $9,500 billion at the close of this fiscal year, which has now started. So if you look at the growth of services business, it has far outstripped the growth of any other business, any other product category, any other geography, any which way you look at Apple's revenue base. Not only that, look at the profit margin of Apple. Apple's services business compared to its products business. The average gross margin on services business is 66%, which is more than double of the hardware business margin, which is at around 31%. Now that 31% average gross margin on Apple's products, devices, is an industry-leading figure. The closest that a company comes to it is in smartphone category, which is Samsung, but it is in the early 20s. So services business is more than twice of the Apple's products business gross margin, and which itself is an industry leading metric, the products business gross margin. So imagine what is it as a continuous cash generating engine, what Apple has created through its services revenue. And on the right hand side, you would see a table which just gives us a breakup of what all is included in its services revenue. For instance, if you look at licensing, not many of us may give it a second thought, but have you wondered, when you buy an Apple device, Google Chrome is the default search engine icon there? Do you know how much Google pays annually to Apple for that privilege, to sit as the default search engine icon on Apple devices? It runs into billions of dollars, actually. So, and that's a component within licensing revenue, which you see in the table. That's just one example. But if you look at how Apple has built its licensing revenue, what Pranav mentioned about brand loyalty and stickiness, that stickiness and brand loyalty is not coming only from devices. But what Apple has achieved is it has created an ecosystem of devices, software developers and partners, business associates. Is a complete system-wide integration, which is what has created this sustainable competitive advantage. And that's the ecosystem approach that I mentioned earlier as the first lesson that we can pick from the investing genius of Buffett and Munger, which is create an ecosystem to achieve sustainable competitive advantage. I could not really think of a better example than Apple in the Berkshire portfolio, because it has a 46% contribution to the overall worth of the equity portfolio. And it is so forcefully and convincingly established how Apple has gone about creating this kind of an ecosystem, which is the foresight that going back to 2016, Warren Buffett would have gained. And that foresight is what he is renowned for. picking up opportunities much before they become the next blockbuster opportunity. And that's where he entered. And since then, the services business has quadrupled, and its margins are more than twice that of the products business. Very good. So I'm quite sure in this group here, which is attending the talk, there must be a few committed, loyal Apple users who actually fulfill the veracity of the statement that Buffett made here. That if somebody gave you $10,000 with the condition that you can now never use an iPhone and you have to switch to something else as a smartphone, probably you still won't take that $10,000. Perhaps I should have run a poll on that question. How many of you would take that offer? So as an Apple user, you would notice that most of you will have multiple Apple devices, and then you start integrating those devices. They talk to each other through the iTunes software and all kinds of file sharing and downloads and apps that you are using. This actually creates an ecosystem for you on which you as the customer, your day-to-day life and routine, right from fitness to entertainment to productivity solutions and personal relationships, all of this depends on it so much that you can't really exit from that ecosystem. The consumer perspective is what I am talking about, which is what creates the sustainability part in the competitive advantage. Okay, so quite a few comments. So yes, some of you may be detractors of Apple. Generally, you will find there are people who are completely loyal followers of Apple, or there are detractors, and these are individuals who, for various reasons, just not price, may not opt for Apple devices ever. But that's the sharp and clear positioning the company has. So from here, let's go on to the next lesson, which is a bit cryptic. I'm talking about capturing value here. Generally, in strategy and in business success, we talk about creating value. Okay? While that is important, no doubt, but equally important, and I would argue more important than creating value, is capturing value. Now, what is it that I mean by capturing value or value capture? Value creation versus value capture. What do we understand by that? And what I am arguing, therefore, through this lesson, which we will now probe into, is Warren Buffett is not only creating value, Buffett and Munger and Berkshire Hathaway. Whenever I mention Buffett in the same breath, I am implicitly also talking about Munger, and we should not discount his contributions and how crucial he is to the overall success of what Berkshire has achieved. But capturing value approach is very evident in something that Warren Buffett and Munger have been doing. Can you guess which company am I talking about here? They have bought $71 billion worth of shares of this company over the last 5 years and 20 consecutive quarters, which means one fiscal year, as you know, is broken into 4 quarters, which means over the last 5 fiscal years, they have bought. There has been no quarter in which they have not bought the shares of this company. Now, that's pretty remarkable and even rare, that an investment fund is buying shares of a company consistently quarter after quarter after quarter for the last 20 quarters. Which company is this? And not a small amount, 71 billion worth of shares of this company. This actually came as a surprise to me, but then again, in retrospect, I was not surprised. Any guesses here? Which company could this be? It isn't Apple. It isn't any of the top 4 or 5 holdings in their portfolio. Okay, keep guessing. I'm getting some responses here. No, it isn't Tesla. You will be actually surprised by the answer. And the answer is sitting right under your nose, literally so. Okay, so I won't tease you any further. The company we are talking about, whose shares they have been buying for the last 5 years, 20 consecutive quarters, and it aggregates to 71 billion worth of shares, is no other company but Berkshire itself. Share repurchase is what I am talking about. Berkshire Hathaway has conducted a share repurchase program over the last 20 quarters, last 5 years, quarter after quarter after quarter, aggregating to $71 billion worth of its own shares. Right? Quite eye-opening, isn't it? And that's the point which reinforces value capture. Can you now connect the two dots? Why would Warren Buffett be buying shares of his own company from the market? Share repurchase, $71 billion worth of it. Partially, the answer is reflected there if you look at the share price trajectory of Berkshire Hathaway. Many of you may be investors, retail investors in shares of companies. You may be having your portfolio, small or large. What signal do you get as an investor when a company decides, like let's say Infosys, TCS, these are companies who frequently come up with share repurchase program. Why would a company do that? And what signal and messaging does it send to investors and the wider financial community in any country, in any context? Okay, yes, I'm getting responses around it. It would boost shareholders' confidence, investor confidence, companies' confidence in their own growth. Very good, Santosh. Yes, it is just not that investors will repose their faith in Buffett and Berkshire, but equally important is that Buffett and Munger believe that Berkshire shares deserve to be priced higher, isn't it? Why else would you keep buying something if you don't believe that the value of it will go up in future, right? It's pretty simple and commonsensical that we would keep buying and accumulating anything as an asset only if we believe that its value would increase and sharply so. And somebody like Buffett would obviously not look at normal returns. He must have a very firm belief for very concrete reasons, given the kind of canny investors the duo are, that Berkshire shares must be deserving much more than where they are today. I mean, there will be a roller coaster up and down happening, but largely the trend has to be that it has to keep moving up, and dramatically so. And we see that reflected in Berkshire's performance. Now, this becomes a virtuous cycle, and that's where I talked about value capture. Now, it's very obvious. We looked at the first lesson earlier. It's very obvious that Berkshire Hathaway has created the kind of value as an investment fund, which is unparalleled, right? No other investment fund, no other fund managers comes even close to it. And over a 6-decade period, that's value creation. So about that, there is no doubt that there is value creation, which is unparalleled. But what Buffett and Munger are also doing, they are not only creating value, they are capturing that value, right? They are not letting Berkshire shares trade at a discount and go to all kinds of investors. They are sending a very clear signal to Berkshire's existing and potential investors that we believe that the shares of our company deserve to be higher and will keep on increasing in value and generate better returns, much higher returns. And therefore, we are investing our hard-earned money in buying more and more shares and acquiring more and more shares of the company. So that's value capture. If you believe that the value of what you are holding would keep going up, why would you like to share more and more of that value creation with others? You would like to share more and more of that value creation with your shareholders. That's exactly what share repurchase in Berkshire has been doing. So that's the idea of value capture being as important, if not more important, as value creation. Okay, very well. Let's move on from here. On that note, let me ask you rather something which is an aside, an important one though. Do you know how Berkshire Hathaway got its name? And this story goes back to something which Warren Buffett considers one of his biggest investing mistakes. He's so humble. The world's most successful investor is humble enough to also openly acknowledge and talk about his investing mistakes, just not in a public forum, but in his annual investor newsletters. And he acknowledges that one of his biggest blunders in investing goes back to the 1960s. And that story, the genesis of that story is the reason why Berkshire Hathaway is the name of this investment fund. Anybody wants to take a guess? That's a very fascinating story again. How Berkshire got its name. And that story is a big blunder, investing blunder in Warren Buffett's own words. You can type a response in the chat window. I'll just wait for a few seconds and then I'll share the story quickly with you, and then we move on to the third lesson. Not really, not hometown. So it goes back to the 1960s. As all of you know, Warren Buffett started investing very early. He used to deliver newspapers. He was a newspaper delivery boy. That was his first job. And he started saving and investing pretty early. Although he came from a well-off family, he was not from a poor, impoverished background. But he always wanted to be on his own feet and started investing very early. So yes, absolutely. Ayush has texted. He bought Berkshire Textile Mill. He started acquiring shares in Berkshire Textile Mill. Warren Buffett considered Benjamin Graham, the great investing guru, as his guru, Benjamin Graham. And Benjamin Graham talked about something which he called as a cigar butt investing approach. Cigar butt, the butt of the cigar or cigarette, right? What is it we do with the butt of the cigar or cigarette? People throw it, but often it has still some tobacco in it. So you can actually pick it and light it up and take a few drags, right? So cigar butt strategy is an analogy which refers to companies which are failing businesses, but they are going so cheap that you can actually acquire shares of that company and sell it to somebody else at a profit. That's cigar butt investing approach. And Warren Buffett started doing that with Berkshire Textile Mill, which was a failing business in the 1960s. And which he later acknowledges that simply because you get something really cheap does not mean that it has great value. And he lost so much money in that investment over 20 years. He was stuck with that for 20 years, and that was his first holding company. And that name stayed. The name stayed, but the investment never worked out for him. Warren Buffett estimates that if he had not invested and been adamant about remaining invested in Berkshire Textile Mill and acquiring its shares, he estimates that the value of Berkshire Hathaway equity portfolio would have been twice of what it is today. In his own assessment, that's what he estimates. So you can imagine how much of a loss he incurred over a 3-4 decade period because of investing and getting stuck with that amount, that capital locked in Berkshire shares, okay, from which he could exit fully only 20 years hence. So that's the story behind. While we are talking about his great successes, equally we have to keep the lesson in mind that we should not really mix good money with where it may turn bad. And that approach in business also, when we are planning capex particularly, is very useful to keep in mind. Okay, so value creation, value capture. Let's move on to the third lesson, which is probably the single most famous phrase related to Buffett's investing approach, where he talks of an economic moat. And here I would change tracks quickly and take you to the whiteboard. Now think of this as a castle. Okay, I'm poor at drawing, but okay, still trying to draw a castle or a medieval palace, like, you know, the kind you have in Rajasthan. There used to be a moat often. Many of you would have seen it, right? This moat we are talking about used to be filled with water and crocodiles, just so the enemy could not invade the castle. And there would be a drawbridge that can be lowered whenever you wanted somebody to enter the castle who you permitted, or it can be raised up if you don't want the enemy to enter the castle. So the analogy that Warren Buffett makes about economic moat is he talks about value investing approach as picking up companies and opportunities that have created this kind of an economic moat, which means something that you value as a business, like market share, profitability, revenue, customer loyalty. That's your castle. That's your palace that you want to defend from competitive threats. And around that, therefore, you have to create an economic moat. For instance, if you have lots of intellectual property, there is this company in my investing portfolio by the name of Tejas Networks. It's a small cap Tata Group company. Tejas Networks last year acquired a company called Sankhya Labs. Sankhya Labs was a small startup based out of Bangalore, but they have 60 plus patents in telecommunications products and equipment. And that acquisition drove up the price of Tejas Networks in a single day. It hit upper circuit for several days at end. From when I have invested, my holding has grown to about 3x in returns. But in the last 2 years, it has increased by almost 15 or 16 times in the last 2 years. Just imagine. That's an example I am citing as how a company can create an economic moat, which is through intellectual property, brand loyalty, different types of unique products and services. Okay, so this concept is linked to the ecosystem and sustainable competitive advantage that we discussed earlier. One of the ways, obviously, of creating an economic moat which you can defend well is to create an ecosystem of products and services on which customers depend, and the brand loyalty and stickiness is high. Now, let's look at how Berkshire follows this approach, economic moat principle. We will look at top 8 companies in the portfolio. As we know, top 6 account for about 80% of the total portfolio value. Here I am showing you top 8. Now, Apple alone accounts for, this is the updated one, for about 49% of total portfolio. Then you have Bank of America, Coca-Cola, American Express. Let's look at the next 4. Chevron, Occidental Petroleum, Kraft, and Moody's. If you look at each of these 8 companies, once again, I'll briefly take you through this. Apple, Bancam, Coke, Amex, Chevron, Occidental Petroleum, Kraft, and Moody's. Each of these companies is in a business where it has created an economic moat. They are enduring businesses. It's economic moat in the sense that they have created some kind of an ecosystem and competitive advantage, combination of brand loyalty, customer base, stickiness. All of those things have created a rather impregnable fortress around the market share and customer share and brand recall and brand loyalty and product loyalty. This economic moat principle, you can see very clearly, is being applied by Warren Buffett and Berkshire. The question for all of us for lasting business success, how can we create an economic moat, even if it's a startup you are running or it's a large business unit you are managing? The question to think about is, how can we create an economic moat? And it's not a small short-term game we are playing. An economic moat may take a longer duration to create, but once it is created, it becomes rather unassailable by your competition. And that's the kind of strategic thinking and execution approach we need to bring for lasting business success. So that's our lesson 3, build an economic moat to defend your market share or whatever as a company you value and you want to protect. The 4th lesson is in strategy in general, the advice given is that we should think long term. We should have the longer term and larger picture in front of us. Absolutely. But act short term. Now, this may be a bit counterintuitive. How can we think long term and act short term and pivot when required, which means adapt according to situations and leverage whatever opportunities come up as and when they come up? There is a fascinating example of how Warren Buffett has been doing it with this company, which is one of the top 8 in its holdings, which is Occidental Petroleum. You would notice here on this chart I have shared with you, it's there was a phase where Berkshire was it acquired 18 million shares of Occidental prior to 2020, and then it sold its entire stake and exited. And then it started acquiring Occidental shares again in early part of 2022. Why would the company do that? And in large tranches, to the extent that today the company Berkshire has almost 1/4 of equity stake or ownership of Occidental Petroleum, which is one of the biggest petroleum oil and gas companies globally. It's US headquartered. Why do you think what made Buffett acquire such a significant stake? And consistently they've been building up stake, including in the last quarter, about $1.3 billion of shares they bought of Occidental. What really happened since early 2022? Anyone? And that's the lesson about think long-term, act short-term. Exploit opportunities on the horizon and pivot as required. Any guesses on what's happening here with Occidental and Berkshire? Look at the period starting from 2022, and I'll give you a hint. There is some geopolitical event that started happening, and where Buffett saw an opportunity on why he picked such a significant stake in Occidental. What geopolitical event are we talking about? It's been grabbing headlines for almost 18 months now. Absolutely. Ukraine war, yes. So look at how somebody like Buffett would connect the dots, and that's the aspect of thinking long term. Buffett believes that because of Ukraine war, so if you look at the overall crude pricing globally, crude and gas pricing globally, it is driven by two benchmarks. There is the Brent crude, right, which is the Brent Sea area, which is typically the Norway and adjoining areas, Brent crude. And there is the West Texas Intermediate Crude, or WTI. These two are the benchmarks of crude prices based on where they are extracted. West Texas is, of course, extracted from West Texas region, and Brent crude is extracted from Brent Sea region, and then it is transported all across the globe. So these two are benchmark oil prices. Because of the war starting in Europe, Brent crude prices, obviously, Brent crude supply was constrained, as you all know. Embargoes imposed on Russia, and also transportation of oil has been disrupted. So obviously, what would happen if the supply of the competitive crude oil and gas is choked? Obviously, WTI prices and a company that has a significant control and share over WTI crude, that company's shares will start looking up, which is what you find here. So we obviously see that the share prices of Occidental Petroleum significantly moved up since 2022. But Buffett has still not divested his stake in, Berkshire has not divested its stake yet in Occidental Petroleum, because Buffett believes, and that's the investment thesis he has, which is the long-term part of it, although he's acting short-term, is that this is a longer-term opportunity here, a 5 to 6 year horizon. That does not mean that the war would go on for 5 to 6 years, but he's taking a 5 to 6 year bet, primarily driven by this upsurge in WTI price and a macro thesis that over 5 to 6 years, WTI prices will remain upwards and stable. And therefore, there is a much bigger gain by this equity stake they are looking at. There is a secondary reason about them owning warrant shares of Occidental, which also would benefit Berkshire shareholders. So to reinforce lesson 4, think long-term, act short-term, as is very evident from this example. Now, this brings me to the last lesson, the 5th lesson. Never sell your winners to make risky bets. This again is one of the biggest mistakes and blunders that Buffett talks about, his investing blunder, and for which I'm showing you a certain chart here of There are two categories of shares of Berkshire. They are called Class A and Class B. Anyone aware of it? Class A versus Class B? What you are seeing here, what you are looking at, is Class A shares of Berkshire. Look at the price trajectory of it. One Class A share of Berkshire today is valued at 5,41,536 US dollars. In other words, all 0.54 million US dollars. 1 million is 10 lakhs, so you can do the maths. One share, Class A share of Berkshire Hathaway on 29th August when the markets were trading, was trading at about $0.54 million. $1 million is 10 crore rupees approximately. So what we are saying is one share, one Class A share of Berkshire was trading at about 5.5, 6.54, let's say 5.4 crore rupees, one share. And what was it trading at in 1993? Just 15,000 US dollars. Why am I taking that period? This is the period which refers to one of the biggest investing blunders, in his own words again, of Berkshire and Warren Buffett. And the valuable lesson, in fact, he refers to that investing blunder as the worst deal he ever made. And which brings us to the last lesson of this talk. Never sell your winners to make risky bets. This story goes back to 1993. That's why I started the timeline. There used to be a company called Dexter Shoe Company, in which Warren Buffett picked a stake and he started increasing his stake. His macro thesis was that this company was making shoes whose designs and product quality was more and more favored by consumers in the US. It also had a growing export market. And for a few years, it really behaved that way. And then what happened? The Chinese invaded, and lots of other Asian countries invaded the US market and other global markets with reliable quality, but 1/5 to 1/10 cheaper shoes and footwear products. And what do you think happened to Dexter Shoe Company? Their margins just collapsed and the company went nearly into bankruptcy. Now, Warren Buffett, what he acknowledges that he never saw this on the horizon, that an Asian nation, the giants from China, the manufacturing powerhouse, can come and replace Dexter almost overnight because of their cheap imports that will invade the US market and other key markets of Dexter. Now, where does Berkshire Class A share price come into picture? He had paid for that acquisition with almost $433 million of shares. It was a share swap deal. It was not a cash deal. So he paid for that acquisition, the stake he took in Dexter Shoe Company, with $433 million worth of Class A shares of Berkshire in 1993. Once again, Warren Buffett, being a canny investor, he estimated the loss because Dexter just evaporated. Eventually, he had to liquidate that investment and write it off. But the $433 million of Class A shares with which he paid the Dexter Shoe Company shareholders would have been worth $15 billion, if I recollect, $15 billion in today's date. Imagine. So that's the loss in Warren Buffett's estimate. What he lost on Dexter Shoe Company is not the amount he invested in the company. The much bigger loss was this $15 billion of loss, where he paid for the acquisition through Class A shares of Berkshire. And which brings us to the lesson: never sell your winners, which in this case was Class A shares of Berkshire, to make risky bets. Now, as a business, very often we will have to make risky bets, isn't it? You can't build a successful business and rapidly growing business if we are not taking risk. We will have to take risks, and there will be risky bets, risky investments as a business we will have to make. The learning is not that we should not take those risky bets, The learning is that we should not use our winners to make those risky bets. So when it comes to raising funds for capex investment, and we realize a capex investment is going to be risky, we have to therefore probably go for debt and not use equity if we believe our equity, which is what Warren Buffett committed as a mistake. He used the equity of his company to acquire a company, another company in the portfolio, instead of using debt, which probably would have just limited his loss to that debt amount and not to what the value of Class A shares would have stood at today, which is worth $15 billion. And now, to conclude, before I invite Sonali to take over, is a parting lesson. It's like a bonus for all of you to think about. There are 5 lessons I promised when we started. And those 5 lessons, just to recap quickly, the first lesson was about building an ecosystem to achieve sustainable competitive advantage. The second was about value capture being as important as value creation. The third being about economic moat principle to defend your market share or whatever else you consider valuable as a business. The fourth being about think long-term and act short-term, where we looked at the Occidental Petroleum example. And finally, never sell your winners to make risky bets, where we looked at Dexter Shoe Company example. As a bonus, I have a parting lesson for you, but that's not about the investing principle of the duo. It's about something else. Can you guess what that something else is? This is a very famous statement Buffett and Munger have made. We made a lot of money, but here's what we really wanted. What do you think they really wanted? What they truly value in building Berkshire Hathaway and becoming one of the world's wealthiest men, what they truly value about what this gives to them is what they're referring to. What they really wanted through this is really well summarized in this statement here, in the classic trademark, witty and rather folksy wisdom style of Buffett, and shooting straight style as well. If we associated with jerks, that was our problem, but we did not have to. We have had that luxury now for 60 years or close to it, that beats 25-room houses or 6 cars. What Buffett is really referring to is that the fact that they have done their own thing and built this investment fund gives them the independence, the choice to not associate with businesses and with individuals where they will compromise on their principles and values. So that's the lasting lesson for all of you. Aiming to be even more successful corporate professionals and even more adorable human beings, is wherever you realize that you will be compromising on what you hold dear as your values and principles, that the lasting success part of it refers to not go ahead with that kind of a partnership or relationship or association, which is what they are referring to as what they really wanted and what they have achieved by pursuing the path that they've pursued. So on that note, I will wrap up. And now it is Sonali's show. Over to you, Sonali. And thank you everyone for being so responsive and engaging with me on the chat box.
Thanks a lot, Ranjan, for this exciting webinar. And I truly believe you did justice to the topic that we planned for today's webinar. And I hope this session was highly informative for the people who have joined the session today. Thanks a lot for taking up valuable time for this webinar. And it was great to have you on board for the session. Thank you so much.
Mahima, do we have any questions for Ranjan before?
There is one I saw. Anil is asking, please explain Class A versus Class B. So primarily, Anil, the difference in the context of Berkshire Hathaway, the reason why Class A shares are so much more expensive than Class B shares. Class A shares are fixed in number. No new Class A shares are being issued. They are limited in supply. More importantly, Class A shares can't be split, but Class B shares can be split. So if you are sitting and holding on to Class A shares, typically Berkshire Hathaway shareholders who have Class A shares, they rarely, if they ever do, they rarely sell their shares. It passes on as family inheritance from one to the next generation. And whenever they sell it, this is what Berkshire's own research they did internally. they found 90% of people who were selling their Class A shares whenever they sold it. In 90% cases, they were donating that money to philanthropic causes, even when they were selling it.
Guys, if you have any questions, the floor is now open for the questions, and Ranjan is right here with us. There's no better opportunity than learning from the expert themselves. You can just put down your queries and questions in the Q&A section. And Ranjan is right here to help you out with your queries. Ranjan, I think you can just refer to the Q&A section. We have a couple of questions there.
Yes, I'm looking at it.
Meanwhile,
Kindly
Mahima, if we can also run the poll.
Website that can provide in-depth details. So Santosh, the one place that I will highly recommend, if you have been excited enough to now know more about Buffett and Berkshire, just go to their website and go to their shareholders and investors tab. You will find annual shareholder newsletters that Buffett and Munger, both of them, write in their own pen. Okay, it's their own words. If you just go through last 5-7 years, and this goes back to, I think, last 20-30 years of letters are there, annual reports are there. This is one of the most insightful and profound example of investor communication told in a lyrical and storytelling style. It is so readable. I mean, I have having been in corporate communication myself and corporate strategy, I have rarely felt like reading the annual report of my own company, which I used to create. But the newsletters that Warren Buffett and Munger write, you start reading it and it is like a gripping but very, very factual and anecdotes and stories driven communication. That's where they talk a lot about life, their experiences, investing lessons, and it's just so conversational with shareholders. So that's the one source I will recommend. There is no better source, and it's available for free. Okay, any other query? Yes, so let me see. Website, okay, let me just text the link here in the chat box. In fact, I'll text the link just not of the website, but the specific web page where you will find those investor newsletters. Give me a moment. In the meanwhile, Sonali, if there is anything you want to share.
Yeah, certainly. Mahima, if we can just also run the poll simultaneously.
Okay, so here is the link I am sharing, everyone. The newsletters you will find here, they actually go back to, imagine, they go back to 1977. Most of you would not even have been born then. So going back to 1977, you have almost last 50 years of rich repository of communication from Buffett and Munger to investors. That's the link where you will find it.
Sonali, can you confirm if you can see the poll on your screen?
Yes, I can. What I would also like to add up here, before Ranjan moves ahead, is that the kind of case studies that Ranjan has been sharing with our, attendees today is the kind of case studies that, you also get to know about and, get hands-on experience on in our program of strategic management and business essentials, about which, you're seeing this poll today on your screens right now. So when we talk about the strategic management program and the kind of experiences that you gain from this program, I mean, this is just a very small snapshot of it, I believe, Ranjan, right?
Yes, absolutely. This is just a curtain raiser, or maybe half the curtain raiser.
Right.
So now you can let me know when we can end the poll.
Yeah, have we got enough responses?
Yeah, there are somewhere around 17 people who have just voted as of now. I'm just sharing the results with you, Sonali.
Sure. Thank you. So learn today to lead tomorrow. By the way, Ranjan, do you have any other questions left that you
No,
need?
that is all. I don't see any more questions. Several people are thanking me for the session, and what I think their curiosity has been kindled, so they want to read up more. I shared the link, but that's about it.
Okay, great. Thank you so much, Ranjan, for joining in.
Yeah.
It was really a pleasure to get all this information from you.
And what a wonderful audience. I loved interacting. I just never realized when 1 hour went by. And that's very rare because I feel a bit apprehensive when I have to speak for this long. But I hope that everyone was still engaged and it was quite evident to me. Thank you, everyone.